there. Good afternoon. Almost there, guys. I promise this is the best panel, best for last. The title of this panel is kind of interesting. It's three different perspectives of the theme of pressure. Everyone faces pressure in this industry, but there are sections of this market that are more under pressure, for lack of a better term. I'll find another word in a sec. And I think we have the three best guests to kind of talk about it. So let's start there. Verdun, Bill, I want to start with you. Where are you seeing pressure in this market?
Well, I mean, obviously, in the alts market, with coming out of the pandemic and having all the public markets, collapse all at one time, in the alts market, there's a little bit of delay in terms of what happens. So now you're starting to see in the alts market pressures around, credit defaults, cash flow in terms of deals. And so with that, you have to have an organization that has scale, that has to have a globalization to it, so they can get the deal flow to come up with and optimize and try to come up with different types of strategies.
How much of that, though, is a pandemic hangover as opposed to kind of a more traditional end to an economic cycle?
Oh, I think it's a pandemic hangover because, alts have been on such a growth trajectory over the several years, for the past decade or more. And as you come out of the pandemic, the global financial crisis, things kind of took off again. But the pandemic, things are just still kind of moving around. There's various issues in terms of, what's going to happen next. And so I think it's definitely a hangover.
Marianne, let's come to you here. Your expertise is capital markets. When I think capital markets, I feel like the easy thing to go to is, oh, well, people aren't IPOing anymore. Done. You go, obviously, into the nitty-gritty. Talk to us about pressure you're seeing across your universe.
Yeah, so slightly different perspective on pressure. I see pressure in public company boardrooms and in the C-suite of public companies. The investing and operating environment has changed so dramatically in the last 18 months and really arguably since the very end of 2021. And unfortunately, there are many business plans and strategic paths to value creation that have not been refreshed and have not been updated for the fact that the cost of capital is dramatically higher for most companies than it was. The cost of doing business is much higher. Supply chains have been disrupted. Labor markets have been disrupted. And so there's a lot of pressure from activist shareholders and just generally unhappy shareholders in C-suites and in public company boardrooms.
I got to say, one of the best parts of my job is as a financial journalist. It's a little kind of playing doomsday every day. If there isn't a crisis a day, I don't get paid. But one of the really interesting pieces of my job is I get to ask the questions, and I get to get away with not having the answers, which makes your guys' job extra tough. Verdun, let's come to you here.
Sure.
One of the biggest parts of navigating this narrative has been, what does it look like in the past, right? The 70s, the 80s, the 90s, are there kind of roadmaps that could perhaps provide visibility for the future? And I think the clear answer is, well, this has never happened before. It's unprecedented. When it comes to kind of issuance and primary, secondary markets, where's the pressure?
It's a great question. And I'll come back to 2009, talking about markets. So if you see the pressure on the private equity side, it's really on private equity allocations. So lots of large investors and private equity funds are over-allocated to private equity because of two dynamics. The first is called the denominator effect. So private equity allocations and commitments have increased significantly since 2016. Then you have in 2021, at the end of 2021, throughout 2022, public markets pulled back. As a result, private equity allocations increased significantly, almost artificially. So if your target was 10%, you may find yourself at 17%, 20%.
Yeah.
So it's hard to keep doing new deals, new commitments, when you're already over-allocated to private equity and over your targets. And so a lot of pressure's there. What's exacerbating that issue is that distributions are down. So if you look at distributions in 2022 versus 2021, they were down about 40%, 50%. Depending on the fund type, it could have been 70% or more. And so what you're having is large investors in private equity funds that want to commit to new funds, but they don't have the capital available.
Well, it's so interesting that you mentioned kind of the 17-20% allocation. I think or an earlier Bloomberg Invest panel, we had a member of Ares Investment Management talking about how, there's the usual 60-40 dynamic, but if you really look at that, it's really saying 100% public, 0% private. And that dynamic has been completely flipped to where a lot of people are saying, maybe it should be 50-50, not bonds and stocks, but public and private. Completely changes the game in terms of the roadmap. You mentioned the financial crisis, though. We were talking about the pandemic hangover with Bill. Walk us through kind of the perhaps hangover from '08 that we're seeing now, 15 years later?
Yeah, I don't know if there's a hangover per se, but I'll go back to 2008, 2009. The similar dynamic occurred where there was a denominator effect. Public markets pulled back significantly. Private markets didn't pull back nearly as much, and as a result, private markets as an overall allocation was a lot higher. So what happened was investors did one of two things. They sold in the secondary market, and that's what I do for a living. They went out and sold older funds, 8, 9, 10-year-old funds, to free up allocation to invest in newer funds so they can continue to stay current in the market with GPs. The other thing they did, for some, they just stopped investing. That's a problem. When you think about the 09, 2010, 2011 vintage years, those are vintages you want to lean into.
Yeah.
You shouldn't be out of the market. And so what we're seeing now, a lot of investors that are over-allocated are trying to stay the course. They're slowing down. They're selling on the secondary market. They're making smaller commitments to fewer managers. But by and large, I see that investors are trying to stay the course and stay current in the market by staying invested and committing to newer funds.
It kind of feeds on the topic of appetite at the end of the day. And I'd not mean to use the word feed and appetite in the same sentence, but here we are. Marianne, let me come to you on that question of appetite here. In 08, 09, major systemic shock, one that I think we faced again in 2020 when it comes to things like liquidity. In your universe, how much of a kind of scare factor is there when it comes to this conversation of liquidity, of a potential systemic shock, especially in the context of the banking kind of turmoil we've just been into? Is that something the folks you're working with are talking about?
Yeah, well, again, in the C-suite and with boards of directors, there's a tremendous amount of focus on how are you going to finance your capital plans. Capital allocation strategies, in many cases, have been built for a different environment where there was seemingly endless liquidity. The cost of capital was cheap, and that has changed. Not only has the cost of capital changed, but the availability of capital for many companies has changed. You made reference to the now almost disappearing IPO market. Let's hope things are starting to normalize there a little bit. We're starting to see some signs of thaw. But companies really have had to re-envision what their future looks like when they really have to question how am I going to access capital and how am I going to fund my growth plan? And if I can't fund a growth plan, if I can't clear my return hurdles based on new cost of capital assumptions, what is plan B?
Yeah. All right, Bill, what's plan B? Just kidding. Well, talk to us again about the story of systemic shock here and liquidity from your universe, where you're dealing with a little bit more with public markets, but also kind of with the alternatives here. Where do you see the issues of liquidity, the issues of kind of a disappearing IPO market, of the secondary issuance story? Does that feed into perhaps appetite for this public-private allocation?
Well, sure. I mean, there's when I think about the public-private and the alternatives, I mean, people have to get uncorrelated returns. That's what they're looking for. And so they don't want to just be in the 60-40 split of, public equities and bonds. So as they move towards this, they look for things that are going to provide that return, that there's going to be a shift to, search for yield, and, an organization that can bring, access to capital, meaning they're investing their own capital, along with finding the third-party capital. Now they're aligning their interests, and they're investing together. That allows them to then go out and find interesting ways to finance deals. So say in the private capital space, you can do private credit, you can do junior capital, you can do private co-invests. And if you can optimize those, you can bring interesting investments to the client and solve what the sponsors and private equity firms are trying to do.
Well, I mean, the magic of of markets, at least what attracted me to them, is you can talk geopolitics to your heart's desire, but markets are really interesting because it's this you're taking a really massive bet on what you think the future looks like, and there's a lot of trends underway already. We've talked about the AI frenzy, we've talked about ESG. When it comes to kind of mega trends, what are you seeing?
Well, I mean, I think about three things in the megatrend. You've got your democratization of alts, you've got ESG, and you got a movement to move to low carbon energy. So when you see those things, say democratization, if you look at private credit came out of the global financial crisis, banks pulled out, private credit went in. You had institutions investing in this. It's a market that grew to today 1.7 trillion. It's expected to grow to 2.3 trillion by 2027, 50% increase. Bringing that democratization down to a wealth client, from institutions to wealth, can go even further. That market's going to continue to grow, and that's a big part of the alts market in terms of democratization of it.
Well, let's stick with that theme of democratization. Marianne, this has been an issue when it comes to, I think, capital markets broadly, both on the kind of the debt issuance side, but all the equity issuance side. And I think more popular with kind of the latest cycle of IPOs, and especially in the conversation of retail investors. How do they access the newfangled kind of securities on the NYSE or the NASDAQ or wherever it is you choose to list? How are you viewing the concept of democratization?
Yeah, so I think of it under the umbrella of shareholder rights, and shareholder rights are expanding, and shareholders are becoming increasingly vocal and demanding. And that covers any category of shareholder that you might want to create. Three big categories that I think of and that I help our corporate clients think about. One is the index complex. They are stewards of trillions of dollars of capital, and while they may not trade in and out based on fundamentals, they vote their shares, and they care deeply about principles of governance. And so they want to be heard, they want to be considered, they want to be engaged with, and they want to be acknowledged. And so one big megatrend is the connection being made to this pool of kind of forever capital. A second bucket is what we might think of as a more traditional institutional equity manager, mutual fund, pension fund, many stops in between, hedge funds. They have become incredibly demanding, right? They are quite vocal now when they're speaking to management teams. It's not just message push from a corporation out to a market, to a shareholder. There's real dialogue. There's real back and forth. I mentioned shareholder activism, but it's an extraordinarily, I think, enduring trend of shareholders making their voice heard within the C-suite. And then the last group is retail. And there are a lot of efforts underway to not only give the retail investor access across all markets to different products, but also give them a little more control with the vote, pass-through voting, right? The notion that an individual investor can not only make their own fundamental investment decision, but that an individual investor should also be able to take responsibility for voting their shares. So there's a lot of really interesting trends.
I feel like I'm having a little bit of kind of succession deja vu as we talked to Marianne a little bit about it. Verdun, let's come to you on that concept. We talked about kind of pressure, democratization. I want to tie that with the story of liquidity, because it's not just about kind of retail folks getting access, but even regular everyday people who are in this market are having trouble with access. How do you fix a problem like that?
Well, I'll talk about private equity, and I'll talk about how it feeds in the secondary market. So if you look at private equity commitments to funds, they've increased fourfold since 2009. The number of active institutional investors committing to private equity funds during the same period of time has increased sixfold. The secondary market volume has increased tenfold since that same point in time. So we talk about pressure, let's talk about ways to alleviate that pressure. One of it is the secondary market. That's a mega trend. 23 years ago when I started in this business, total volume globally was about 1.4 billion. This year, it should be about 130 billion. But when you think about that, that only represents about 1% of all available capital out there in funds. It's tiny. That penetration rate or turnover rate is exceptionally small. Over time, through awareness and a need, whether it's a latent need or you're aware of the need, people will pursue exits and liquidity to relieve the pressure that we're talking about today through the secondary market. And I think I'm excited about that because there's one thing that's for sure, we've seen pressure before, this too shall pass, but for right now, what do you do about it? And I think one of the answers as it relates to private equity and the pressure caused by overcommitment to funds is the secondary market.
Well, in terms of, you use that word exit, and I think that's almost, it feels like the market's worst nightmare here, because as we talk about exiting private equity or private markets in general, there's also this exodus coming out of public markets as well, or at least a complacency or a hesitance to get back in. Bill, weigh in here. When it comes to kind of this concept of mass panic or mass exodus or something like that, how concerned are you? Or are you perhaps seeing, as we wait for this recession that at some point will come, I've been waiting for 2 years, is there some sort of read-through or trade-off between the public or private, or do you kind of see some sort of return to what we've been seeing in the past couple of decades, some sort of return to normal?
Yeah, I think you're going to see a return. One is, I think investors today are holding on to cash because they don't know what quite to do with it. You know, the equity markets are volatile, rates are going up, they don't want to put their money into that. They're learning, you know, with the alts markets, you know, as we've talked today, with the alts markets getting more and more available to the individual investor, they're waiting to see what kind of information can come to them. How can they invest? And as they get more information, they'll be able to invest. And that trend's not going to stop. They're going to have these uncorrelated returns to their portfolio. It threw them off in the pandemic when everything dropped to the bottom, and they know they have to have these other investments.
I like that you mentioned the concept of information, because, Marianne, I think this is very relevant to what you're talking about, kind of this growing shareholder base. We've talked about access to the securities themselves. Let's talk about access to the information in terms of making the right trades or bids or investments or whatever you want to call them. Is that an issue you're seeing with this kind of growing retail shareholder base?
Well, I think in some cases, people are quite concerned, and it's probably not as big a concern as some make it out to be, but it's also probably a somewhat bigger concern than others make it out to be. For example, let's take the case of a large M&A transaction. Maybe it's highly complex, maybe it's very sophisticated, maybe it has some industry specific or deeply complicated structuring nuances, and you have a large retail base. How do you communicate with that audience about some of those nuances in the context of a big M&A transaction?
Yeah.
They're going to vote this deal, right? Are they going to vote for it? Are they going to vote against it? And based on what? So I think there's a lot of golf to play on that issue. I don't think it's particularly straightforward, and it's not black and white.
Yeah, and something I think that's going to get even more complicated as you get more and more, not just, I want to say, investors in one country, but it becomes a truly global phenomenon. In our last about, let's say, 90 seconds here, no pressure, let's talk about what keeps you up at night here. What is the thing that you worry about? Verdun, let's start with you.
I wouldn't say a lot of things keep me up at night, but...
Really? You sleep really well?
I don't sleep a lot, but when I do sleep well. What I would say is certainly geopolitical risks. I would say lack of liquidity. I think my fellow panelist was spot on. The cost and availability of capital, cost is increasing, the availability of capital is decreased. And so that worries me a little bit. You look at the exit market, the IPO market, for all intents and purposes, is non-existent right now. And so as an investor, you're investing to get a return. The question is when. Yeah. And so certainly there are going to be longer hold periods, which will apply more pressure. We started with that. It will apply more pressure. So I think about, when I make an investment, when is this capital going to come back? Clearly, what is the return going to be, but when will it come back? That's the important question. So that's what keeps me up at night.
Well, thank you for doing my job and connecting it to the beginning. I can go home now. Marianne, what keeps you up at night?
You know, I think just being humble enough to know there's a lot of things out there that we still don't know. And I think sometimes we in this world, this sophisticated financial world in which we live in, we feel like we've been able to study everything. We know where every risk is. We've evaluated it. We've priced it in. And we're ready for it. And I think history has proven that's not true. We're never really fully on top of the unknowns. So I worry about the unknowns.
Good financial advice and life advice. We'll get it on a T-shirt. Bill.
I think about just being nimble. you don't know what's going to happen next, and so you have to get nimble. You have to move quickly. If you want to move quickly, you can make the right investments. If you make the right investments, you can grow your revenues and things like that. So it's always trying to be nimble and make the right calls. So you're always, I'm always thinking about that as the next step.
Well, when you guys get tired of making the right calls, maybe you guys should join the financial media. We're doing great over here. Thank you guys so much for your time. We really appreciate it. Fascinating perspective. Thanks, guys.